Even though a host of tax crimes may apply in an underpayment situation surrounding payroll taxes, the most common penalty is the trust fund recovery penalty, and this is very problematic in and of itself from a financial standpoint. As we've already stated, the IRS requires employers to withhold certain amounts from an employee's check: payroll taxes, federal and state withholding. Since the employee never sees these funds, a constructive trust under the law is formed around these funds for the benefit of the government. The employer, along with any responsible party working for an employer, is under a duty to remit these funds with the constructive trust around them to the federal and state government. If the employer, including the responsible parties within that employer, fail to turn over or remit these withheld taxes to the government will hit them with a 100% penalty for the amount that was supposed to be turned over that was withheld from the employee's checks, the trust fund portion. What a lot of my clients have found unfair in this situation, it is not uncommon for the government to look for multiple deep pockets here. Maybe not even a deep pocket, just somebody they can hold accountable that's going to put pressure on the owner of the business to make good on the payroll taxes. Like maybe somebody related to the owner of the business that works in an accounting function. They got a big target on their back. I once saw an owner that had his nephew working for him in his accounting department. I believe the IRS went after the nephew not because they thought he had deep pockets. This was a 22-year-old kid that was making $14 an hour and had no net worth. But I believe they went after the nephew to put pressure on the business owner to pay back the back payroll taxes. It is not uncommon for the entity itself, the owners of the business, the managers of the business, and people in the accounting function to find themselves simultaneously named as responsible parties, and the IRS will begin to collect against everybody named as a responsible party simultaneously. The trust fund recovery penalty is joint and several liability, meaning the government can collect it from anybody on the hook for it, and they will assess 100% of what's due against everybody that's on the hook. So if the total short paid payroll tax is $300,000, every responsible party will be hit with a penalty of $300,000. Again, the IRS collects interest a multiple of times on the same underlying debt. In addition to this debt being joint and severally liable, it's personal debt. What does that mean? First of all, it means that the government has no problem in case law piercing the corporate veil and assessing this tax against the owners of the business, the managers of the business, or anybody employed by the business. The additional tax, penalties, and interest stemming from short paying payroll taxes is going to cost the owner of a business significantly more money than if they just went out and borrowed from a third party. Doesn't make sense to do it. What's most important here to understand, this debt is personal liability, meaning that the government can force you as a business owner to sell your business and collect the equity in your business. They can force you to sell your personal assets, possibly even your home, even though it takes a court order, or any low-hanging fruit to pay back this payroll tax liability, and they've been known to do it. Often the first battle that I face in this area is I got a revenue officer that's trying to make up their mind. Do I shut down the business, padlock the door, or choke off sources of revenue by levying its source? In other words, if you have customers, going to the customers and saying you can no longer pay this business, you have to pay me. Do I choke it out of business by choking off revenue? Do I lock the doors to stop the bleed? Or do I leave this business in existence so that this is a source of revenue to pay back the tax that didn't get paid? So often what I have to do as your representative is put on a dog and pony show to explain how we're, number one, going to stop the bleed. We're never going to short pay payroll taxes again. We're going to talk about what revenue can be increased. We're going to talk about what expenses can be decreased and how you're going to survive this business crisis, because it is a crisis. If you're short paying your payroll taxes to stay afloat, you're just minutes away from bankruptcy, and the government knows this. What you need to know that bankruptcy isn't even an option here. These trust fund tax liabilities that are personally assessed against you and your employees and the managers of the business, they're non-dischargeable in bankruptcy. That's not going to help. What you also have to realize, it's very easy for the government to notice when back payroll taxes are accruing and getting larger. First thing to look for is some sort of a payroll tax return to be filed without an accompanying payment. Worst case scenario, if no clue of this is going on, when your employees ultimately file their personal tax returns and include their W-2, the government's going to stand up and take notice when that W-2 gives that employee credit for federal and state withholding that they didn't receive, and for payroll taxes that they didn't receive. That's one reason the government is so vicious in these situations. The government will honor the W-2s of your employees even if none of the federal or state withholdings were paid in or the payroll taxes were paid in. They'll honor those W-2s, give them credit for it on their personal tax returns, and come after you with a vengeance, treating you like you reached into the national coffer and stole from them. Moreover, you'll find the courts backing the government's play here, and they'll be non-sympathetic to your plight. The trust fund recovery penalty will be applied against anybody who was responsible for collecting and remitting payroll taxes and willfully failed to do so. In addition, anybody who willfully attempted to evade a payroll tax, which is a much more serious criminal matter. Willfully in this situation means that the responsible party knew that they were required to collect and remit payroll taxes, and they either intentionally chose not to do so, or they were indifferent as to the requirements of the law. Furthermore, I'll say it again, anybody that either attempts or actually evades payroll taxes can potentially be charged with a crime.